Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, February 16, 2010. The main theme today was a rally in risk sentiment as commodity prices surged higher, which helped to boost higher yielding commodity-backed currencies such as the Australian and New Zealand dollars. Even the recently battered euro, which is struggling under the pressure of fiscally stressed Greece, gained against the dollar as Eurozone finance ministers tried to reassure markets that Greece's fiscal concerns would be kept under control. In other words, no news about Greece today was good news about Greece. Also, we had U.S. equities rallying strongly following their open after being closed for the holiday on Monday. We had a strong New York Empire Manufacturing Index, which helped to boost risk appetite. Also, overnight, Barclays reported strong earnings data, which helped European equities. If we take a look at the Aussie dollar pair, we see that we broke above resistance at the 0.89 level in overnight trading, and then in the New York session, we extended gains past 89.50, reaching a high almost at the 0.90 level. We have been following these key levels for a few weeks now. First, we had moved above the 0.88 level following a strong employment report from Australia. Then, after hitting 0.89, which had changed its role from support to resistance, we retested our support at 0.88, and now we've moved above the 0.89 level. So this is a very sort of well-behaved move by the Aussie, as we had a test of resistance, back to support, and now we're breaking above the resistance. Similarly, with the New Zealand dollar US dollar pair, we broke above the 0.70 level in today's trading, reaching a high near 0.7050. That brought us back to the area we had seen in late January that had acted as a sideways consolidation zone. So you see that we broke back into this level. This decline here came after a very disappointing New Zealand fourth quarter employment report. So it also coincided with the increase in risk aversion as the euro struggled with its Greece debt. So we had moved down to the 0.68 level, but now we have moved back above 0.7. And now to look at our third commodity currency pair, the US dollar Canadian dollar pair, we see here as well a break below support at 1.0450 as the greenback remained pressured today. This broke below a 61.8% retracement of this rally here from January 19th to about February 10th as we moved 520 pips from 1.0250 to 1.0770. So today we broke below that 61.8%, meaning that this retracement correction is a strong one. Here we're looking at the euro-dollar pair, and we see that the New York trading session with our surge in equities has helped this pair to rally in favor of the euro. We broke above our overnight high around 1.3680, and we were testing the levels near above 1.3750 by noon New York time. Our next clear level of resistance comes now at the 1.38 level, which was these highs that we had seen in the middle of last week. What today's action does do is break this short-term downward trend we had been seeing to end last week, and we see that we did move above the 50-period moving average. In fundamental data from the Eurozone, we had Germany's ZEW Economic Sentiment for the month of February, and while it did decrease from January's 47.2 to this month's 45.1, the decrease was smaller than expected, which was a net positive from the release. The financial market experts surveyed in the release expect the economy to recover slowly from the crisis. They see the prospects for the retail and consumer goods sectors and for automotive industry to remain poor. They are also worried about the labor market, budget deficits, and the euro. Taking a look at our other big European currency, the UK pound, we see that we remain confined within this triangle pattern, though today we saw, depending where you place this, if you put it at last week's high, then we're testing that resistance level right now at around noon New York time. The pound, like others, is responding to the positive risk appetite, and we'll see if it's strong enough to boost this pair out of this consolidation zone. You can also place the resistance here, so disregarding this one spike, and we see that we have moved above that level, so that could be an important first indication. However, you do want to see it move above this level before you before the outlook for the pair could be turned to a positive one. We also see here in the pound-dollar pair that the risk appetite we have seen helped the pair to surge above its high from last week around 1.42, and we have seen this sort of labored rally following a sharp drop last Thursday in the pair, and we are now working to correct that, and so today we have moved above the 61.8% retracement of this slide. Our initial break was at the 50% level. So this means that the rally in this pair might be gaining some momentum. In data from the UK, consumer price inflation rose 3.5% on the year in January. That was the highest rate since November of 2008, but it did reflect the return of the value-added tax rate to 17.5% from the reduced rate of 15% during 2009. A jump in short-term inflation had been signaled by the Bank of England, as it said that inflation was set to rise above 3% and should remain elevated for some months to come before slowing again towards the end of the year. In addition to the VAT increase, which one spokesperson said had a quite significant impact on the CPI data, the sharp year-on-year rise reflected a pretty big rise in prices of transport, which rose at a record rate of 11%. Fuel prices, which is within the transport subcategory, rose 25.3% in January from the year ago. So that reflected much higher fuel costs inside of the inflation. Core CPI, which excludes prices of energy and food, rose to 3.1%, which was also a record high. And in the US, we had the Empire Manufacturing Index come out for the month of February, and the General Business Conditions Index rose 9 points to 24.9. 42% of respondents reported that conditions had improved over the month, and 17% reported conditions had worsened. New Orders Index did fall 12 points, but it remained positive at 8.8, and the Shipment Index was also positive 15.1, though that was a slide from last month's 21.1. Employment remained just above zero, and future indexes suggested that the conditions in the manufacturing sector should continue to improve in the next 6 months. And a look at our final pair. Here we're looking at the dollar-yen. We see movements similar to what we had seen in the pound-yen, where the dollar managed to rally rather sharply in New York trading, setting a new 2-week high for the pair. If we look at a Fibonacci retracement of this fall from 91.20 to 88.50, we see that we moved above the 61.8% area in today's trading, which we had poked above in last week. So all around, a day of risk appetite and gains by higher yielders such as the Aussie, Canadian dollar, euro, and pound against the dollar and Japanese yen. Now let's take a look at what we can expect from the fundamental docket in the upcoming session. Tonight at 6:30 p.m. Eastern, Australia posts a measure of its leading index, and at 6:50 Japan releases a report on services sector activity. Overnight, the UK has another 2 important releases, the claimant count and unemployment rate, aka the jobs situation for the month of January in the country. Also, we get the Bank of England meeting minutes, where we can see deliberations about pausing the quantitative easing policy that the Bank of England had. At 5 a.m., the Eurozone will post its trade balance data. Tomorrow, there's a good amount of U.S. releases as we get data on construction, including housing starts and building permits. We get data on inflation in the form of the import price index, and on manufacturing production as we get the industrial production figures as well as capacity utilization rate. At 2 p.m., we also will get the U.S. FOMC meeting minutes for the January 27th meeting, where the Fed had upgraded its assessment of the economy, but we did have one dissenting vote in terms of taking out the language that says that the Fed will keep interest rates low for an extended period of time. So that'll do it for today's market recap. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading this week.